All right. Hello, everyone. It's excited to do this. It's been a little while since we've done one of these calls. This is going to be a good one. It's some really good wisdom and quotes from some of our favorite investors. But as always, click chat if you'd like to add us a message while we're going. Raise your hand. We can unmute you and you can talk that way. But otherwise, I'm going to go ahead and turn it over to Dave.
Well, good. Thanks, Jen. And thanks, everybody, for taking time out of an amazingly beautiful day out there. Goodness gracious. A perfect day and a perfect market day at all-time highs in spite of all that's going on in the world. And it is a messy world out there for sure. There's no doubt. Lots of things to worry about, from elections to inflation and so on. And we are happy to talk about the wisdom of great investors. That's what we're going to touch on today. And so Jennifer, if you want to start us going there, that would be great. All right. Let's go ahead and go talk about this, because this is really what I really wanted to hit on today. And that is, how many times does the end of the world as we know it need to arrive before we realize that it's not the end of the world as we know it? What a perfect quote from Michael Lewis as we think about all of the things that are going on in the world. It is absolutely incredible. How many things we are worried about. We worry about everything in the world. There's so much noise out there. And we all think we can kind of rise above it. But as we look at all those worries, they're commonplace, right? They're all commonplace. We worry about debt ceiling. We worry about China. We worry about politics. We worry about every single thing. We always have. It's the way we're wired as human beings. But I just thought it would be fun to kind of take a look at, if you will, a recent enough period, because sometimes we talk about the history of the markets. It always bounces back and people feel really great about the market on a historic perspective. It's like, yeah, fine, we got through World War II. Yeah, fine, Cuban Missile Crisis, all that stuff. But this is recent stuff that we can all remember, all of these things. And this is prior, at the market high, if you will, in 2007, before we headed into 2008, if a person would have invested $10,000. And we look at day after day almost, right? All the things that are in the news. And Obama gets elected president. It's the end of the world. And then we're going to go into QE1. And then we end it. And QE1. We're going to have a flash crash. The next shoe to drop. Meredith Whitney says we need to get out of the municipal bond market, that trillions of dollars of municipal debt would all go away. And in spite of that, as you can see, the market keeps doing well. In fact, investing right before the 2008 market, I'm not even going to call it a setback, bear market, you still average 10% returns. And it really got noisy, right? And then for those people that don't like Donald Trump, that was the end of the world. New York Times famously quoted, "Sell all your stocks, it's all over." Everybody was sure it was all going to end. It's always all going to end anytime soon. Anytime soon. So it's really important for us to understand that this happens all the time. We're always going from one crisis thing to worry about to the next. It's constant. We can't get away from it. We simply cannot get away from it. It's just this constant noise. We might think, oh, I don't watch that much news, or I'm not really all that wired in. I don't worry that much. I don't check my account every day. You can't help it. The cell phone will tell you that the market hit all-time highs. You get all this doomsday news. You're just simply looking on Facebook or something, and then boom, everybody's posting the end of the world again, as we know it, for the umpteenth time. Why we're going to hyperinflation is going to kill us just this time. It didn't before, but this time it will. And it just goes on and on and on and on. And we all think it doesn't affect our emotions, but it's very important to check our emotions. We need to. As Benjamin Graham says, and it's just a super quote, I love this. And Benjamin Graham, the father of value investing, and Warren Buffett talks about him a lot, right? And there's lots of great quotes out there. But investor's chief problem and his worst enemy is likely to be himself. We don't think that about ourselves, but it is. In the end, how your investments behave is much less important than how you behave. Now, I know you all think we're above that, but as you'll see, we're not. You cannot believe. Now, if you see this, is just another chart of really, mentioning some of the bad news, right? And what is actually going on through the bad news is the market, which is in blue in the background there, is the S&P 500, is going higher. It's doing just fine, thank you. But look at the red line. Literally, with all of this news, the average investor is taking money out of the market. And you might say, that doesn't make any sense. Where would you put it? They're putting it in cash. Unbelievably, at zero interest rates, record amounts, trillions of dollars are building up in cash. It affects us. All of that noise affects us greatly. And we could try to pretend it doesn't. We can act like it's not a big deal. It's a huge deal. People are driven by this constant bad news. And we take calls every single day. Most certainly, no matter what the market's doing, every single week, we take multiple calls. I do on the radio. Yeah, but what about the inflation? What about this? What about that? Because people are online and they might be doing something simple like reading emails, and the little ad on the side pops up. And what's that ad doing? This guy thinks that who called whatever crash it was, whatever thing it is, I don't even know who that guy is, is now predicting some doomsday thing. It's always a doomsday thing, not, hey, it looks like sunny skies, sunshine and rainbows all the days of our life. It doesn't look like that. They never do that because fear sells. It causes reaction. We don't think so. We don't think so, but it's there every day, and it's very easy to click. And once you do, the algorithm will know it, and you get fed more and more and more of that all the time. All the time. I always give this analogy, or not an analogy, it's a true story. But I remember I'd ordered something, this just goes back a number of years, okay? Something really simple. I tell you, it was underwear, okay? So men's underwear. So what do you think I'm getting all the ads for? One time at Amazon, I ordered a package of underwear. And for a year, I'm begging Jennifer to come in and order something on my computer, please, anything. Because I'm getting male model advertisements running all the time. It's incredible how fast that moves. Now imagine if they think they've got somebody hooked. What's going to happen to you? You're hooked on this negativity. What do you think every article is going to be doing? It's going to be playing on that to try to drive you to a website, to drive you to buy a newsletter, gold, equity indexed annuities, all sold in fear. All sold in fear. So careful, just don't even let it in, but because it's always there trying to get us, okay? Because it can lead us to try to think we can time the markets, right? Because and this is so true. Peter Lynch, of course, a famous mutual fund manager, far more money has been lost to investors trying to anticipate corrections than actually lost in the corrections. It's not even close. It's not even close. And as you'll see, when people do, and you miss just a few days, and many of you have already seen this chart, but I've got a surprise coming too. You've seen this. If you're fully invested for this 20-year period here, and that includes the last decade for stocks, not too bad to do 7.5%. But if you miss just 10 days, you cut that return in half. 10 days out of 20 years. That's unbelievable. If you miss 30 days, you actually have negative returns. 30 days in 20 years you missed, you actually have negative returns. It's truly remarkable. And honestly, multiple studies, time after time, they're called Dalbar studies, about the actual cash flow, money in and out of the markets. It's unbelievable, but you couldn't try to be that bad. People trying to time the market. They're so bad at it. It feels like it's a natural thing. Yeah, well, I'll just set them aside, wait for the elections to be done. I'll just set aside, we got to be worried about that. So Joe, the horror of all horrors, is going to be elected, and he gets elected. That's going to tank the market. Didn't. Same thing with Obama. Same thing with Trump. Didn't tank the market. Markets are bigger than that. We don't think so. We're always looking for an excuse, 1 foot out the door. We're getting ready to go. We're always thinking like that. We let our emotions run away from us. Look, this is the other point of that chart. You got to know that you can't time the market. Because I know somebody out there, maybe all of us, are going, yeah, but if you avoid the worst 10 days, then you're going to make a fortune. Well, how easy do you think that is when 7 of the best 10 days occurred within 2 weeks of the 10 worst days? I'm going to get in, I'm going to get out, get in, get out. I'll capture the best. I'll get out before the worst. You can't do it. It's not possible. It's not possible. You have to be in to catch the big days. And if you catch the big days, you win. That's it. And the price of that is you capture the worst days, you capture down days, you capture down months and down years and down markets in order to, like today, in spite of it all-time highs on the Russell 2000, the S&P, the NASDAQ, the Dow, all across the board. Can't happen. Not going to happen. Trying to spend trillions of dollars, inflation out there. Fed's going to leave. Guess what happened today? The Fed left. They said we are going to taper. This is the beginning of tapering. So interest rates are going to skyrocket. Well, they didn't. Now, again, back to why. Why doesn't that happen? It doesn't happen because markets are predictive. The Fed has said we're going to. And guess when we meet? We're going to meet for 2 days at the beginning of November, and we're going to taper in November. So they do, and they announce they're going to taper. Now, why would people go, whoa, no, they can't do that, and panic? And yet almost every day, it's amazing. Almost every day, I'll hear people, well, what's going to happen when they stop tapering? What's going to happen with inflation? They've announced this for like a year. I think we're ready for it. It's amazing how people think that nothing's going to happen. Nobody's positioning portfolios until the actual day it happens, even if it's been announced. Again, we don't think the way the market thinks oftentimes, which is way ahead. We've got to think ahead. And that's exactly what the market's doing. All right. So I want to share one more quote with you. And this is just super good. And one more thought about overall markets, because we really need to be thinking about that and thinking about the markets and why they don't always react the way we think they will. A 10% decline in the market is fairly common. In fact, it happens about once a year. Investors who realize this are less likely to sell and panic, and more likely to remain invested, benefiting from the wealth-building power of stocks. Christopher Davis, his family's been in the investment business for years. A 10% decline in the market is so common, it almost happens once a year. But you would think even a 5% correction was reason for everybody to get on CNBC, start checking out their portfolios closer. Why, I don't know, because they're like, oh, good, let's see how much money we quotes lost today, right? Like owning Apple when it moves from 150 down to 145 is a loss. How about the fact that you owned it since it was like $5? Do we think that? We don't think that way. You see, we're wired as humans to just be really awful about the way we think of things. We're such losers. Well, we're not. Buying and holding works. All the old wise investors say so. Things work out. And then we try to reinvent the wheel. And we know we're not supposed to market time, but this is one time, we just step aside for a while and you're done. You really are. You walk down that road, it doesn't end well. People don't come back. Even if you're right, you don't come back and get in. People that thought, you just get out early in 2008. I heard it all the time. Yeah, I got out in 2008. Yeah, I know when. After the second 20% drop at the end of October. See, the market had fallen 20% from its highs in 2007 by the beginning of October. And then it really got bad. So now those people got out in 08. Down 40. Down 40, and they didn't get back on in April 9th. They didn't. There was not an announcement. This is the bottom. And in literally 90 days, the market was up 45%. Now, you're not going to buy in then. There's no way you're going to buy in then. No, because prices were in the second shoe to drop, and you saw all the charts, and QE 2, 3, whatever, this, and the whole Europe was going to implode, right? That's when we got to worry about Crete and really amazing things like that. And Greece, with the GDP the size of Vermont, that's going to take down the whole world. It's not. But that's the news. And news is always fed to us. It's super negative. It's super high velocity. And just think about what's going on now with the news. We're going to talk, and this is not a political statement. This is simply a statement of fact about what's happened to news ratings with no Donald Trump in the White House. CNBC, CNN are dying. Nobody's watching. Nobody cares. Nobody watches CNBC when the market hits all-time highs either. Nobody's watching. Nobody cares. They can't wait till the market has a little volatility to then get in there and see if they can just dig a little bit and get you to watch more and worry more, because that's the only time you watch. That's it. Okay, it's really something, really is. Now I want to show you how normal volatility really is. Okay, this is every year. This is how much the market falls, really every year. At some point, it's down, right? Now, weird years like 1995 barely went down. In fact, in the early 90s, the market barely budged, barely. Sometimes we have volatile periods, and right now we're in one that's not particularly volatile. But this goes on and on and on. Now, this is the lows. This is normal. This is what happens. But also what happens is that the market tends to be up. You see 4 green bars there. Those are all down years for sure. But the green bars, as you see in the up, if the up will go, there we go. You see it right there. You see that we have, I got to move this out of the way here. There we go. You see what's going on here? This is what we see as the up market, but we're focused and worried about the down times, which are temporary, certain to occur every single year. Every single year we have these. But Dave, what do you think is going to happen in the market? It's going to fluctuate. But what do you think about? No, not worried about that. I'm worried about making sure that we're trying to own the great corporations of the world, not time something that inevitably goes to all-time highs. It was interesting today in the Wall Street Journal. I'll share this quick story with you. Funny how these things time out, right? But it was saying, it was this little editorial page, right? That the Dow would be in the next 50 years at over 1 million. Well, that's just simple math. The last 50 years, projecting the next 50 forward, same percentages, the Dow's at 1.5 million. 1.5 million. Isn't that crazy? Without dividends. Without dividends. It's a crazy number. It's absolutely crazy. And when we think about that and put this in the perspective of where we've been for the last 40 years that I've been doing this. And by the way, go to YouTube if you want to see it. I think it's fun. Dow 30,000, really neat thing. We do that. And when you think about that, and we think about how far we've come in spite of high inflation, low inflation, high interest rates, low interest rates, politicians that are, I mean, come on. Are all presidents even remotely good? Do they make good, wise financial decisions? Not usually. No, not usually. They're boneheads. And they're trying to buy votes with somebody else's money. It's just, that's the way it is. In spite of that, strong businesses go out, called creative destruction. Let's go kill those guys. And they do. They come up with something new. It keeps working. It always has. It's just hard to keep that perspective. It really is.
All right, so I have to jump in here because we have one more quote that we tend to live by here at Petso. You're going to definitely recognize the person that put this one out there. And you know, it's true. As you look through this, and we talk about it all the time, and we say, optimism is really the only realism there is. We have to live that way. If we don't, we'll get caught up in all those things that we just went through. We here as Petso, we like to work as a team. The reason why is when things get negative, we have people to talk to, build each other up, challenge each other in our thoughts. So if one of us comes in and we're, oh, this is terrible. Did you see this news? We can sit down and think, okay, let's flip it over and look at the other side. Let's look at the data that's on the flip side of what we're talking about. And that really does come down to optimism is the only realism. And that's how we like to live here. All right, we're going to ask questions, comments, anything at all. Please raise your hand or chat with us. Well,
no questions?
No questions?
No,
right.
What about, or why this time is different, all that?
Why don't we want to
I know,
own gold?
I didn't open that door very wide for anybody to run through that one.
Great. What about gold this time? What about Bitcoin? All these crazy things that we're still talking about, even though the real work is just buying the best corporations of the world.
It is. It truly is. It's very hard, and don't discount all of that, in all the inputs, all the negative inputs. Don't discount it. Just don't discount it. It does affect us. Well, thank you for that. Yeah, thanks. All right. Well, you know what? It's all-time highs. It's a beautiful day. Thank you all for tuning in.